reason I press this is not to make you say uncle, but in kind of lay terms, what was done at investment banks, different risk profile at the more regulated commercial banks, is extraordinary leverage. I mean, akin to a small business person who has $50,000 in net worth, or a family borrowing $2 billion in some instances, $1.5 million, with much of that money due overnight. And what I'm trying to drive to is whether there's a clear recognition that despite all the risk models, on a fundamental basis, excessive risk was being taken, notwithstanding all the models that existed.
Well, as I said, I concede with looking now, and again, everything is context driven, and I couldn't be more clear. After 10 benign years in the context where we were, look, how would you look at the risk of a hurricane? The season after, we had 4 hurricanes on the East Coast, which was absolutely extraordinary, versus the year before. Rates got very low for risk premia on the East Coast of the United States. That year after 4 hurricanes, everyone's nervous of such. Rates went up spectacularly. They're lower again. But is the risk of 4 hurricanes any different any of those times?
Mr. Blankfein, I want to say this, having sat on the board of the California Earthquake Authority, acts of God will exempt. These were acts of men and women.
I'm just saying that if you're asking...
These were controllable, is my only observation.
I agree. I sit here and read testimony to the effect of reducing our balance sheet, raising capital. Clearly, we are much less leveraged now. Consequently, I wish we were much less leveraged then, even though we were much lower leveraged than others, and we got cash on our balance sheet, and we did better than under those circumstances. But if you're asking me, would I do something differently knowing what I know now with respect to that capitalization? How could you not? Of course.
But I also wanted to put in context the level of risk and the level of distance. This is something I think I'll repeat it again. Let's do this then. Let's now move to questions from other commissioners. I'm going to stop at this moment and move to Vice Chairman Thomas. Thank you very, very much.
Thank you.
Thank you, Mr. Chairman.
Start with Ms. Murrin.
Thank you, Mr. Chairman. My first question is to Mr. Blankfein. A question for you about AIG. Could you talk a little bit about when the government supported AIG and enabled them to close out your exposures to risk at AIG? Did anyone ask you at any point to take anything less than 100 cents on the dollar?
I never got a request myself about taking less. It didn't come up in any conversation that I can recall. Subsequently, somebody in my organization who was going back and forth with this was after the AIG, this was a couple of months later, at the time when they were closing out a portfolio called, I think known as Maiden Lane 3, told me that he got a question to the effect that at least contained the inference that he drew, would you be willing to take less? And he said he couldn't answer that question now himself at his level, and he then said it would never came back up again to him, and as I said, it never came back to me.
Did he further that question up the chain of command at your firm at any point?
I think he, I can say I didn't get it. I didn't get it. He might have told his boss.
Could we talk a little bit about your interactions with the regulators? In particular, when you think back on the events of 2007, 2008, there are obviously a lot of people that participate in risk management that are either internal or external at your firm. There are regulators, there are auditors, there's internal audit, there are your external auditors, there are committees of your board. At any point, did any of those entities or individuals raise the issue of the quality of the assets on your balance sheet or of the leverage that you had at any point during 2007 or later?
We're a mark-to-market firm, and we have businesses, important businesses, we have distressed businesses. We have businesses that specifically go out and buy distressed assets, but they're marked correctly. So our auditors wouldn't say, I like this asset, I don't like that asset. Our auditors would say, is this asset appropriately marked? And we engage on them, and I think I talk to the auditors each time, and they tell me we do a very, very good job. We not only mark them, we go out and, to the best I can, get external benchmarks and go out and test the marks. So it's not a matter of, we would go out, and if a client came to us and wanted to sell us a very distressed portfolio, Lehman Brothers debt, or anything like that, we would have a bid for it. That's our role in the market. We'd buy it. They could get it off their balance sheet. We'd have it on our balance sheet, but it has to be marked correctly. That's the real issue. Is it marked correctly?
And it sounds like you have quite a bit of discretion in that regard, and that it doesn't sound like there was a lot of challenge to the kinds of marks that you were making.
Oh, I'm sorry. There is huge challenge in our organization. We spend a lot of time.
Mommy!
Our control system.
I was referencing outside of your organization, specifically your auditors or the regulators.
Oh no, they go over our books and records. It's a very, very long process. They not only audit the marks, they audit the processes by which we get the marks, and they test them.
So then, do you think that in light of what's occurred, that they were doing a great job?
I think they did. Again, I'm living within, I'm answering within the scope of my knowledge. I don't engage with the audit process. I get a summary, or I talk to the audit partner, and I'm a member of the board, and so I receive it there. So there's limits to what I can tell you in assessing them, but we're quite satisfied. We're satisfied with our auditor. Otherwise, we wouldn't have him.
And the regulators as well?
Well, we went through an evolution of our regulators. Obviously, we were regulated during the period. We were regulated by the SEC as our primary regulator. That was an institution that came in with the last few years, where you had one main regulator, and then that regulator, of course, switched when we became a bank holding company, which would have been in the fall of '08.
But it is their responsibility, am I correct, to help you determine what risks you may or may not be undertaking as a firm. Is that right?
I would say help to determine what risks. I think of it is that they surveil us, and we, in the first instance, would do something. We're always disclosing to them what we think. It's a ongoing process, not that we do something, they look at it, we engage them, there's an open, and this is the intention of the process, to be engaged, but then they look, and very critically, if they didn't like it, they wouldn't let us do it, or would stop us from doing it. That's their role.